Hello everyone and welcome to the ICRA podcast on Banking Sector Outlook FY2026. My name is Sachin Sachdeva and I'm the Vice President and Sector Head Financial Sector Ratings at ICRA. ICRA forecasts a stable trajectory for FY2026 for the banking sector as banks navigate growth revival amid evolving asset quality and regulatory shifts. ICRA has revised upwards its projection of credit expansion in FY2026 to Rs 19.521 trillion, which is 10.7 to 11.5% YOY growth from its earlier estimate of Rs 19.0 to 20.5 trillion, which is 10.4 to 11.3%. This is supported by improved demand post the goods and service tax rationalization and liquidity boost via the cash reserve ratio cut. The growth overall is expected to be largely driven by the retail sector and the MSME segments. The sector is also witnessing several regulatory changes. The proposed expected credit loss framework is likely to impact the core capital ratios of the banks by maybe less than 150 basis points. This will also be partially moderated by a favorable impact on account of the risk weight changes. Further, since the transition path is allowed up to March 2031, the sector's capital profile is expected to remain comfortable. On the asset quality front, there had been a slight uptick in fresh non-performing advances generation rate in Q1 FY 2026, particularly among private banks, due to their relative higher share of unsecured loans. Going ahead, ICRA expects that the fresh NPA generation rate is expected to slightly remain elevated, although we have seen it slightly being volatile and declining from Q1 to Q2. On the asset quality front, there had been a slight uptick in fresh non-performing advances generation rate in Q1 FY 2026, particularly among private banks due to higher unsecured retail and MSME advances, although the same decline in Q2 FY 2026. The overall asset quality trends remain monitorable amid broader macroeconomic developments, and ICRA expects a slight rise in the NPA generation rate for full year FY 2026. The margins appear to have bottomed out in H1 FY 2026 and a slight recovery is anticipated in H2 FY 2026, barring the impact of possible further rate cuts. The return on assets and return on equity are likely to trend marginally lower in the range of 1.2 to 1.3% and 13.5 to 14.4% respectively in FY 2026 compared to 1.3% and 15.5% respectively in FY 2025. Nevertheless, these levels are considered sufficient for growth without significant reliance on new capital. The key credit challenges to watch out include emerging asset quality challenges, limited demand from large, well-rated borrowers, and global macro developments. Our goal is to provide you with in-depth, insightful credit research and analysis. We hope this serves as a valuable resource for your strategic business and investment decisions. Thank you.